A 51% rise there in earnings for the first quarter of the year, and that really shooting past any analyst expectations. Just looking at one of the analysts saying that it meets 53% of their overall forecast for your earnings for the year. What were the key drivers in terms of this first quarter rebound?
Okay, thank you very much. And I think the fundamentals of the business, if you have to go back a little bit into the last financial year when we had to do the cleanup and try to reset our agenda, so to say. Now, having gone through that process in the last financial year, we are now ready for our growth. And what you have seen in this first quarter is actually an icing, a little bit of the tip, of the iceberg. And we expect that in the rest of the financial year, these are the kind of figures I want to post to be able to show a full recovery from the last issues of last financial year.
Perhaps improving confidence, of course, in the company as you have this turnaround strategy, looking at your cost growth of 13% year on year. Also, a strong improvement in that cost-income ratio, sitting at 51%, where it was at around 67% for the full year of 2011. How sustainable is this? How have you managed, firstly, to bring down costs so dramatically, and how sustainable is this cost-to-income ratio?
Well, if you recall that our fundamental business, is that of taking money and lending money. What we've been able to do is to set up an infrastructure that is scalable. And what we've been able to achieve this year is to see our revenue grow in that direction without necessarily increasing our cost of doing business. So, in a cost-to-income ratio is a relationship between two figures, the cost on one side and the revenue on the other side. So the revenue has grown, even if the cost has remained flat. And that's what we're trying to do, to be able to improve on all of those indices as we go along in the new financial year.
Now, the non-performing loan to total loans ratio sitting at 5% is still considered pretty high. What is your target for that NPL ratio for the end of 2012?
Well, I think fundamentally what we will say is that if you look at this same time last year, we are actually at about 14% NPL ratio, which I'm sure is a very high figure compared to where we are today. We've done a little bit of cleanup in that direction, and where we are now is about 8%. We believe that by the end of this financial year, we should be way below the 5% that is the maximum that is regulatory advice at this point in time.
Can you give us any guidance as well on the return on equity ratio that you're looking at for 2012?
Well, return on equity, we believe that having come back from the loss of the prior year, we should be doing anything above the 10% mark. And that is how much we can say for now. This is the very first quarter of the year, so there is still a lot to go.
Looking above that 10% mark, though, and of course, news filtering out now that you could be on the lookout for perhaps a tie-up with another bank. Is that going to be a bank based in Nigeria? Can you give us any clues into the type of banks that you are possibly in talks with right now?
Well, I'm sure you know that we are a growing bank, and therefore we do not foreclose any opportunity. If you recall, in the last financial year, there was an attempt for us to actually get into an MIA situation with one of the banks in question, and that did not go through. So once we have another opportunity, I'm sure we'll let the public know. But for now, we just want to keep our options open. We're either going to grow organically, which is what we're doing at the moment, or if opportunity arises for inorganic growth, we'll then also come to the public with that. But at this point in time, there is no such immediate issue.
Are you concerned around the threat from larger banks with the M&A activity that's already taken place, and how that's going to impact on your market share in the banking sector right now?
Well, we should be concerned, and as a good player in the market, we then know that there will be some shift and some changes in the playing field. But it should not be of a big concern to the extent that we have a niche play. I'm sure you know we're the best SME bank in Nigeria, and therefore, in terms of retail business, we are very comfortable that we are still going to lead in that market. And if any other bank is beginning to look into that direction, I'm sure they're the one that will be doing the catch-up. So for now, we are very comfortable with our strategy, and we believe that we can deliver in this financial year and beyond.
You've also indicated that you're looking to raise around $200 million. That's by issuing bonds. Give us an update on who you'll be targeting and when you're likely to come to the market with that bond issuance.
Okay, thanks for that question. And I think fundamentally it derives from the fact that having posted some losses in the last financial year, it has taken down the equity in the business to some level where we believe that we need to shore it up. We do believe that for purpose of growth and for purpose of capacity development, we need to have some additional capital. But we don't intend to go into the tier 1 capital at this point in time, essentially because the share price is still on the low side. And you know that there is a lot of apathy in the Nigerian capital market at this point in time. So we've opted to do tier 2 capital for about $200 million US. And at this point, we are in a lot of discussions already with what you call multilateral agencies. And I think those discussions are already at various stages of advancement. And we will expect that by the end of this quarter, which is quarter 2, some of them should begin to come in. And by the end of the year, all of it should have come in.